Hey traders, it's Rachel with your option of the day for May 2nd. For today's trade, we're looking at a strategy known as a broken wing butterfly in Google parent Alphabet. So looking at it on MarketSmith, we can see that shares have been trading in a narrow range below the 5% buy zone from a 106.69 cup with handle buy point. Shares are holding support above their 21-day line. The company just reported earnings on April 25th, which barely moved the stock up or down. Earnings fell over 11% year over year, while sales rose slightly, up 3%. While the stock is in a strong industry group ranking number 5 out of IBD's 197 groups, the RS line looks a little shady right now, chopping around in recent months. On a weekly chart, we can see that the stock has pulled back quite a bit as well in recent years. Google began its decline near the end of 2021. The current cup with handle is the first official base in a while and can also be seen as a bottoming base. So today, we're looking at a strategy that has no risk on the upside, a healthy profit zone around the current price, and limited risk on the downside. The strategy is known as a broken wing butterfly. A broken wing butterfly with put options is created when an investor sells 2 puts at a given strike price, then buys 1 lower strike put and 1 higher strike put, relative to the 2 short puts. The lower strike put is going to be further away from the short puts than the higher strike put. That makes the broken wing. Each put in this setup will use the same underlying security, the same expiration date, and a different strike price, except for the 2 short puts, which will have the same strike. A broken wing butterfly with put options is a trade that's designed to benefit from decreases in underlying volatility. The trade will make a profit even if the underlying price goes down, as long as it does not stray too far from the short strikes. If it does, then the trade will start to lose money. But the good news is your risk is defined with this strategy, so you know your worst case scenario in advance. On the upside, the trade has 0 risk because it's an overall credit. So you'll earn the biggest profit if the stock closes right at the short put strike at expiration. So now with all of that said, let's take a look at my trading platform and set up a real trade using Alphabet. So using the June 16th expiration, we're looking to buy 1 put with a 100 strike, sell 2 puts with a 105 strike, and buy 1 put with a 108 strike. Notice that the upper put is 3 points away from the middle put and the lower put is 5 points away. This broken wing butterfly trade can be placed for very little cost or even a small credit. This means that the trade has no upside risk if the stock moves above 108. The worst that can happen on the upside is that all the puts expire worthless, leaving the trader with a small credit. The downside max loss is $175 in this case, and the maximum gain potential is $325. The ideal scenario is for Google to stay between 102 and 108 for the next month, but finishing around 105 at expiration will get you the maximum profit. In terms of risk management, I would set a stop loss if Google breaks below 102 and a profit target of 10 to 15%. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us for our regular options content where we break down a new trade idea every day.